Have you ever bought a stock and immediately watched it drop? Over 10 years ago, my strategy was to chase hype stocks, panic when they pulled back, and pray they would move back up. Unsurprisingly, this cost me thousands. Then an investing coach showed me something embarrassingly simple. Most investors don't lose because they pick bad stocks. They lose because they enter at the wrong phase. So, in this video, I'm going to give you the exact 4-phase system I used to identify strong trending stocks, enter at the optimal time, and only commit money when the stock is extremely likely to offer consistent profit. This is the exact system that helped me and members of our private community double their accounts over the past 2 years. Okay, so phase 1 is where you filter out the stocks that should never make it into your portfolio. And it's a step that can dramatically increase your profit potential when you use it correctly. A stock's past reflects its future. If you have a stock with a strong trending past, it will likely trend well and grow your account consistently going forward. Think about it like promoting someone at work. You don't give a bigger role to a person who had one good week. You promote the person who's delivered consistently over time. That track record doesn't guarantee the next quarter, but it's the strongest evidence you've got. Stocks work the same way. A stock that's been trending up for a while is showing you it's already been performing. Buyers have been supporting it. And when you start phase 1 by choosing stocks with that kind of proven strength, you're setting yourself up for the next 3 phases to work the way they're supposed to. That's why phase 1 is solely focused on the stock's history and the shape of the trend. And the easiest place to spot that is on the monthly time frame. What you're looking for is simple: a stock that's been pushing higher for a sustained stretch, ideally 12 to 24 months at a very minimum. Okay, so let's have a look at this on the charts. Okay, so what I have for you here is the stock of NiSource. This is the monthly time frame, which is where we like to look for phase 1. And you can see that this stock has pushed up over a number of years, a very beautiful trend, in fact, exceeding that 12 to 24 month period that we look for. This is what we look for in a phase 1 stock, a very clean, linear move to the upside. This kind of consistency tells you that the stock can build momentum over time, which is where the best long-term moves come from. So if a stock checks phase 1, as NiSource does, great. Now it's earned the right to move on to phase 2. And if you want the full breakdown of these phases, they're all outlined inside our stock market blueprint. It's the same tool our community and I use every week to find the best stocks with the potential to rise 80% even more. I'll put the link below so you can download it. Okay, now before I found my mentor, I stumbled on this part because I never had the patience and I didn't understand the mistake I was actually making. A key thing that a stock does after it has had a big move is to lose momentum. Nothing continues moving without a big charge along the way. If you have an electric car, there's only so far you can go before needing to settle and recharge before the next big journey. The market works in the same way. It will move and then it will correct and pull back. Depending on how big the initial phase 1 move was, the stock will likely move on into a period of consolidation or a sideways market, bouncing between 2 price levels, a support and a resistance, or a floor and a ceiling. Rookie investors make the mistake of keep buying a stock that has experienced a big move, thinking it will just go up forever, but end up losing and giving their hard-earned profit back to the market because the stock eventually corrects and comes down. Now, I made this mistake a lot and it lost me a lot of money. The correction process causes many to lose profit, but it is a crucial part of the market cycle. Now, once I understood this was phase 2 of a 4-phase system, investing became simpler. Phase 2 is actually something to embrace and not fear. It is the reset after a big trend, the calm before the storm. After a big trend ends, it goes into consolidation, forming a base. This base is the catalyst for another big trend. This reset is not welcome for new investors because it requires patience, but experienced investors embrace it with open arms. Once we find a stock in this phase, we know that there is a strong likelihood that it will grow our account exponentially. So this is what phase 2 looks like on the charts. Okay, so I'm still on the monthly time frame. We're still looking at NiSource, the stock we looked at earlier for phase 1. And what we can see here is that NiSource is currently in phase 2. It's stuck between two levels. If I just get my marker, we can see that it's stuck between a high, which is the resistance, and it's stuck between the low, which is support. So you have a stock that is stuck between roughly $19 at the top end and $16 at the bottom end. This is now in phase 2, a consolidation or a sideways market, which is very natural after a strong phase 1 move up, as we've seen here. Now, what we do is we simply place an alert above that high, roughly around $20. So when price moves, we get that notification of the breakout above that ceiling or that resistance level. Now, it could take days, it could take weeks, it could take months for that breakout to occur. What we don't want to be doing is staring at that chart all day, waiting for the breakout, which is why alerts are so powerful. But ultimately, it doesn't really matter, because when we find a few stocks like this that have good phase 1 history going through this phase 2 sideways market, there will be opportunities all the time. The stock market is full of thousands of stocks, and all we need to do is be ready for the next phase, the next breakout, and the next uptrend. Okay, so now phase 3 is where most people miss the money. After a stock has rested in phase 2, a sideways market, this is the moment it starts waking up again. And if you're not ready here, you usually end up chasing profit later, leaving a lot of money on the table. Once a stock has been consolidating for a while, the breakout is like the first sign the next move might be starting. It doesn't guarantee a bull trend, but it's a strong signal that demand is stepping back in, especially after a long phase 2 resting period. The key is how the breakout behaves. Rookie investors will see price poke above the consolidation zone, above the resistance or the ceiling, and in turn, they jump in immediately. Then the stock snaps back into that phase 2 sideways market, into that range, and ultimately traps them. That's the classic fake breakout. What we want instead is a clean, confident move up. Price pushes above the range, above that resistance or that ceiling, and holds its ground. That's your clue that buyers are taking control and the breakout has real energy behind it. And this is why phase 3 matters so much. You're not entering yet to avoid the dreaded fake breakout. You're getting in position. You're simply getting ready to make a move. Because if you also wait until everyone's talking about it, well, you're usually late. So timing is absolutely key. Okay, so let's switch back to the charts to have a look at phase 3. Okay, so this is where you literally have to read what price is doing. This is where you have to eyeball the charts and really train your eye to understand what we're seeing on the charts. Now, we're still looking at NiSource, but I've come down to the daily time frame, which is the time frame I like to enter in on. It's where we can see the trends within the larger trends on the monthly time frame. Now, here is the phase 1 that we saw earlier on the monthly time frame, a nice clean linear trend to the upside. And then it's at this point here, what we can clearly see is price bouncing between two levels. It's this sideways market. So if I just mark the high of that range, this is the phase 2 range that NiSource is in. Now, you've got the consolidation zone here. We can see that price has been bouncing right inside, and then you start to see this move to the upside. There's been a couple of fake breakouts here that I mentioned earlier. It attempted to break out here, move back into consolidation, another fake breakout, move back into consolidation. So this is really where that patience comes into play. What we're looking for is a breakout where you get a solid bullish candle out of this area of consolidation. The close is the absolute key because it tells you that buyers didn't just push price up for a moment, they kept control all the way until the close of the day. Remember, we're looking at the daily time frame. So if I move this along by 1 bar, you can see that now we have a solid breakout signal. We have a tool that marks these breakouts for us, hence this little green marker below the breakout bar. And that's a strong sign that the stock is more likely to keep on pushing higher, that confirmed move out of this area of phase 2 consolidation into phase 3. Now, as already mentioned, if you compare that to a fake breakout, price sort of pokes around and gets excited above and below this zonal area. It moves above it, comes back down again, moves above it, comes back down again. There's no real confidence that the market is breaking out. That's the market basically saying, not yet. The buyers haven't quite taken control. Once again, we want to see a solid breakout bar out of consolidation, and our tool here, our marker, does that for us. And here's the thing, when it breaks out and stays out like this, that's when it immediately goes to the top of our watch list, because now that stock is showing strength that could actually turn into a long-term bullish trend. Okay, so phase 4 is where you finally get paid, because this is where the move stops being possible and actually starts being real. We've done the work through phase 1, phase 2, and phase 3. Now we're looking for the stock to prove that it could actually trend, which is phase 4. After the breakout, the best stocks don't just spike once, they start to climb in a steady rhythm. They push up, pull back, then they push up again. And that's the signal we're waiting for, because it tells us that the buyers are very much in control. Now, on the chart, this is what it looks like. So still on the daily chart for NiSource, this was the breakout that we looked at earlier from phase 2 into phase 3. And then we can see that from this point on, it's pushed up higher. Then it pulls back, finds some area of support, and then it continues, pushes up, and it breaks and closes above that previous high. This is the next breakout signal confirming that the trend is in play. Now, that's not random movement. That's a trend actually forming. It's the early sign that the stock wants to keep on pushing up. Now, here's the thing. This is also where people still mess it up. Some jumped in too early without a plan. Others hesitate, then chase when it feels already obvious. What we do is actually neither. What we actually do is we set an entry level and place a buy order with our broker. We don't market buy in the moment. We have an extra layer of protection to avoid a fake breakout. The entry is actually placed a few points above the high of this breakout bar. Now, if price breaks above that level, we get triggered in. And because all other earlier phases are already checked, the trigger isn't a guess anymore. It's planned entry ultimately into a trend that's already proving itself. Then we manage it like a professional. We control risk first. If the trend fails, we're only down a small amount, ideally around 1%, sometimes 0.5%, certainly never more than 2% per position. That way, one losing investment doesn't hurt you, but one good trend can do serious work for your account. And as the trend develops, we can add sensibly on further breakouts, but not all the way until the end of the trend, ideally in the early stages of the trend. So we're building positions only while the trend is still healthy and not when it gets to the point of exhaustion. Because if you do that, the last few positions will turn into a loss. Getting in right at the early phases and stopping your entries at a certain point allows all, if not the majority of the positions, to be profitable. And this is exactly why having the phases mapped out matters. If you want the full breakdown, they're all outlined inside our stock market blueprint. I put the link below so you can download it. And this is why phase 4 is so powerful. It turns investing into a routine instead of a feeling. When the stock starts printing that higher push, controlled pullback, higher push pattern, you don't debate. You place the order above the level that confirms the next push, above the bar that confirms phase 3 into phase 4. Now, if it goes, you're on the train early. If it doesn't, you're not in. And that's the value. A rules-based entry that keeps you out of investments you shouldn't be in and gets you into the good ones early enough to actually profit from the trend. So let's switch back to the charts. So we can see that NiSource has climbed over 30% since that breakout from phase 2 into phase 3. A very clean linear climb to the upside, being very profitable for those who got in and positioned themselves correctly. Now that you know the 4-phase system I developed to extract profit from the market, you need to know how to find the high probability stocks to invest in. So watch this video where I show you how to narrow down your list to only the strongest performers.